Welcome to the Up Your Average podcast, where Keith and Doug give no-nonsense advice to level up your life. So buckle up and listen closely to Up Your Average.
Good morning, Doug.
Good morning.
It is a great day in central Indiana. It just seems like it gets better and better.
Yeah, especially bouncing off the northern lights last night.
Man, I heard about that. I'm heading north today, so maybe they'll have them tonight too. I assume it just keeps going, doesn't it?
The further you go north, I don't know.
I would think so.
Maybe.
So you saw them in your backyard?
Yeah.
All right.
Yeah.
Very nice.
And you could see them better through your iPhone. I don't know what those engineers at Apple did to make them pop through the iPhone, or maybe that was just through the Kodak camera. It works just the same. I don't know, but they were just gorgeous. I hope you guys got to see them. If you didn't, your Facebook friend did.
That's how I heard about them. Connie told me. All right. Today's Up Your Average, we are going to focus on buying wisdom and what that means relative to taxes. And we are not tax advisors. We are just offering a little education here. The idea is that we can help you, I think, improve your decision making in regards to your taxes. I'm thinking about the 1040 form. When would you say was the first time that you became familiar with taxes, Doug?
Oh, it would have been pretty early on, maybe 18. And
So did you have to do your tax return?
yeah.
Okay.
My dad, he studied accounting at Indiana Business College. And
I don't think I knew that about you.
So my dad has an accountant's mind. and
Okay.
brain, and so he would walk me through his taxes and help me do mine back then.
Well, for me, it was Mrs. Holtzman is a junior or senior in high school. We had to do our 1040 return as part of school, as part of civics or whatever it was called. I don't know. I don't think they do that anymore.
No, I doubt it.
Yeah, I think it would be important because the process of it. I talked to a couple different accountants and asked them their opinion, and their opinion was somewhere between 10 and 25% of their clients probably actually look at the tax return after it's done.
Yeah. Okay.
And so familiarity, I think, can help you in your decision making. It can kind of up your average on what you do financially to have awareness of your finances. So 1913 was when the first use of the 1040 form happened. And I don't know if you all can see this with me, but you had to put your income, some deductions, and then your net income on line 3 here, and then some other calculations. And then over here, if your income exceeded, was between $20,000 and $50,000, you had to pay 1%.
Yeah.
And then you had a 100% tax increase above 50%. You went from 1% to 2%, that's a big tax increase. That percentage, people are like, oh, it's only 1 percentage point. But in managing your resources, paying attention to those significant increases can help you make, I think, better decisions. So this tax return, I think it was 3 pages long, and it included 1 page of instructions. My guess is on the current 1040, I can't even imagine there's any line that only has 1 page of instructions.
Back then, I wonder how intrusive that was, though. I mean, what year did you say it was?
1913. Yeah.
And so, how many people could do the arithmetic that it would take to process that? When you're growing up on the farm, you're how many people even did that?
Well, I think buying wisdom is a timeless thing as far back as you go. So to have somebody that can help you with things, I would buy the farmer's wisdom to have my produce, right? And so that there was probably a lot more barter that went on back then, but I don't think anybody can get them done for less than a couple $100 these days. And that's just for low income people. That's a lot of money. Well, when do you think most people probably even pay attention to it? Do you think anybody's even trained on their 1040 anymore? Or?
No, I think probably like everything else, you just go to the YouTube and it's smoldering and on fire, you deal with it. And then if it's not, you just keep moving along.
Yeah. And that's why I wanted to kind of talk about this, because I think you're just filling in blanks and not really, when you're filling in blanks, you're not thinking, how does this impact me? And that's what I think I'd like to cover today, is ways that it can help you paying attention to why different lines matter on your tax return. I looked at the definition of marginal. It means on the edge or incremental. And that's how our tax rates are. They're marginal. You go from one edge to the next, just like on this one, when you got to $50,000, your tax rate doubled to 2%. And then when it got to 75,000, it went to 3%. And it just keeps, each of those is a stair step. And knowing where you fit along the stairway can help you make decisions that might help you either when you're younger or older, or maybe even in between. But particularly as you're younger and older, there's events that force you to use your margins, I think, to your advantage. I think it's important to realize there are some steps that are baby steps and some that are monstrous too. And I'll show you that on our current tax rates, where you go from a little 10% increase in your tax rate to almost a 70% increase. And so if you can manage that better, you're going to have a better, I think, view of the future. Here is the current, let me share this with y'all. This is the current 2023 1040 tax return. And we don't know yet, I don't believe, what the 2024 is going to look like. Probably very similar to this.
I'm excited for it to come out.
Are you really?
No.
Yeah. I mean, recently they added this section of digital assets, and who could have imagined in 1914? And so the two things I want to focus on today, one is this section right here is your filing status. The most common, I think, are single and married filing jointly. And if you're married and filing separately, I would encourage you really to have conversation with your accountant, because usually historically those tax rates have been pretty significant and maybe not to your advantage, but there's reasons people do that. So you've got your main sections here, your filing status. Down here is your income. That lists all your income. And then over here, you've got your tax and credits. And then payments, that might be your estimated payments or withholdings on things, but there's a whole list of them here. And then I think what people a lot of times focus on today are refund and the amount you owe. It seems like to me, a lot of people.
What's the bottom line? Yeah.
Well, they seem like it's a bad tax year if you owe an amount.
Right.
Regardless of how much you've paid in payments along the way, right? Like I think you need to take payments and what you owe into account so you can have, I think, the appropriate amount of disdain for the federal government.
Yeah, that's a good word. Focus on the payments.
Yeah.
That's good.
Yeah, because getting a refund just simply means you had too much up here in this payments section here. So let's jump on to how this would really help somebody in those two segments here. So the filing status, like I said, most people will either be single or married filing jointly. And the married filing jointly, if you lose a spouse, you can file that way all the way till December 31st of the year of become a widow or a widower. And it becomes, as difficult as it is, it becomes important to take that into account in years like that.
Or if you're dating someone right now.
December 31st wedding, yeah.
Think about closing the deal now.
Yeah. Well, or at least looking at it, see if it makes sense, right? Yeah, we've got a wedding next month.
Is that going to be your gift to your future son-in-law? Hey, now you can file.
You can file jointly. You guys, I'm doing their marriage counseling, and this week, it's either this week or last week, we're doing it via Zoom, and I looked them straight in the face and said, "You guys are poor. I'm rich.
Yeah.
You guys are poor.
Yeah.
Like, don't look at me to how to live. You guys need to learn how to live poorly." So you've got your married or single. The example I'm going to show you is Keith Tyner, 1984.
Okay, cool.
Yeah, so it's single. And then once you know your filing status, the other thing you need this year is on line 15 is your taxable income.
Okay. Now we're talking.
Because those two variables are what help you when you look at the marginal tax rates. All right. Are you guys doing good? Are you following so far?
Are you going to explain what taxable income is?
Taxable income, I'm not really going to go into great detail.
Yeah,
it's the sum of all your income sources minus your deductions. Yeah. And that gives you the point at which you can kind of begin looking at this and saying, how will I use the marginal tax rates to help me? So I'm going to get personal if you guys don't mind. I came into the workforce in 1984, cranking out
you were crushing it, dude.
$27,600. I had my chest out. I was strutting around.
That's double what I earned in 1998.
I'm sorry.
You were killing it.
That was kind of a big deal.
Yeah, no wonder you were looking at that Z28.
Oh, yeah. It's so not, I didn't even know what that meant. I know I came into the workforce almost earning as much money as my mom did after a career of teaching. And so if you inflate that, this is the website. If you want to do this exercise on your own to kind of see how this works. If you inflate it from 1984 to 2024, today you'd have to make $83,600 to be where I was as a 22-year-old kid, which is kind of interesting. So that's the number we're going to use in the marginal tax rates, and we'll use that looking at today. But in the meantime, I want to take you to 1984 to show you where I was at. So if you see up here that I'm single, that was the marital status. And then my income would have been in this range right here, between $23,500 and $28,800. And so my marginal tax rate as a entry-level employee was 30%.
Yeah. So that's based off your top dollar.
The marginal is the last dollar of earnings I had. And so I didn't even understand this as a 22-year-old that I was paying 30%. I remember I put my suit, my tie on, I had memorized my sales pitch, and I had gone into the meeting with my boss to negotiate $1,000 pay raise.
Yeah, well, that's significant.
Well, yeah. It seems significant, yeah, but I didn't realize 30% of that was going to get taxed. It was going to get taxed for federal, let alone another, say, 8% for FICA.
And your standard deduction back then probably was not.
Yeah.
So
So I'm probably only getting 60% of that pay raise. So for arguing for $1,000, I'm looking at a $600 actual pay raise, which is okay. But I didn't even understand how much of that. Like Uncle Sam was sitting there, go get him. It's a funny picture. I like that. Yeah, and so that's really how Uncle Sam is on your investing too. Because like Uncle Sam doesn't really share that much in your investing losses, but if whatever gains you make, they're right there with you. Yeah, so that was 30% back in 1984.
Now see that top tax bracket.
Oh, let's go back there. Yeah, I want to point that out to y'all as well. 1984, the maximum tax bracket for a single person was $81,000 and was 50%.
For those of you listening in the car, 50%.
And I had friends at Texas Instruments that were single making that kind of money. I had no idea how punitive that was to them. I thought they really weren't making a ton more money at that point when they're given half of it. Well, they're given more than half because they were still paying FICA, I think. Yeah. That's just really an absurd idea, but that was 50% in 1984. So if we go back and I take the inflated, $83,000 and bring it to the current marginal tax rates, that 83 or whatever it was, $80,000 is going to be 22%. Isn't that interesting? That it's more than 25% less of a tax rate today than it was in 1984.
It's good to be living now.
Well, and the funny thing to me is, like, I've been preaching to you all to defer taxes all these years, and maybe we shouldn't
Like a
have,
Roth IRA.
maybe we shouldn't have deferred as much.
I think the disclaimer and the answer to that is
We cannot predict the future.
we
Yeah. So look at this. See the baby step here that I was telling you about? You went from 10% to 12%. That's a 20% tax increase. You guys follow me? It looks like 2 percentage points, but 2 percentage points is 20% of 10. So in this example, that's a baby step.
And I think it's important to realize that that first 11,600 is taxed at 10.
Right. That's after your deduction.
Yes.
So that's why we want to
Yes.
we want to encourage you to look at these things with your accountant. And so then when you go from 12 to 22%, once you make that $151st dollar over at 47,000, you are having almost 100% jump in your tax rate. It's from baby step to a monstrous step. And then they give you a little break where you only have an 8 or 9% raise to the 24% bracket. And then they smack you with a 33% increase going to the 32% bracket. And so watching these things are really critical. If you're married and you're retired and you're looking at this thing, if you're not using all $94,000, you might think about what strategies I can use. If you're up here in the 22 and 24, you might think about that too. What does that look like for us going forward? And why I wanted to point out historically to you what this means is what historically our government does when they begin to raise taxes on you is they begin to fill in some of these gaps where it's 12 to 22%. You may have a 15% tax that just kind of chisels a little bit. And then between the 24 and 32, and then probably what they'll do is they'll smack the people at the top as well to say that they raise taxes on the top income earners.
I can't wait to go back in time in the future and reference this podcast. We'll say, remember when Keith told you there's going to be some slices in there, some increases.
Well, and it's you kind of got to be a nerd to look at this stuff. But I spent some time going through a file that went back historically and looked at the marginal rates. Probably this year I went and looked back about 50 years to kind of give me a thought of how the government has done this. But I summarized all that for you with this particular graph. This goes all the way back to the early taxes in the 1913s here, and there's two colored lines. The blue is the top marginal tax rate, the top step. Like you've hit the pinnacle of success in your career. You've been the best at the best. And as a government, this is what we want to do for you. And then the green is the lowest marginal tax rate. And what does that mean to you? How are we going to affect you in that situation? And if the lowest marginal tax rate is 0, that means those people really aren't paying anything in taxes. And really, there is a 0 tax rate today. If you look at what the standard deduction is, if you're not making more than the standard deduction, you're not paying any taxes, not any income taxes. You may be paying FICA or sales or property taxes, but you're not paying any income taxes. So that's the history. That's where we're at now. We've been in the last 50 years, we've been below this 40% level for most of that time. However, when the reason Ronald Reagan crossed over from being a Democrat to a Republican is he would go out and make a movie. In that one movie, his pay would push him right up to this 90% marginal tax rate. And if he made a second movie, 90% of his wages would go to the federal government. And he's like, what? This tells us we don't want you to work anymore. It's really what it tells the average person.
Yeah, just the psychological effects of this. You have to think differently on it. And I talked to a good friend of mine, an accountant, and I said, what do you think about the marginal tax rate? He says, don't be afraid.
Don't be afraid of it.
Don't be afraid.
Well, I think that's what the point of this is. Don't be afraid, but I think our clients should know what their marginal rate is, because it can help them, help us, and help their accountant in making some of their decisions. I thought I'd show you one more graph. This is kind of how different people are paying taxes today. Strider Elias, I think it's Elias, I guess. He works alongside the First Trust people that we trust and accept their economic data. But like the bottom 50% of wage earners in the United States today pay 2.3% of the federal income taxes, and the top 1% pays 46% of the taxes. And so the other 50% is kind of spread between the middle income people like you and me. Yeah. And so they probably can't get much out of these 1% people. So when the increases happen, it's probably going to be the guys driving next to you down the interstate. And again, you can't fear it. You just have to manage it. And that's part of why I wanted to talk about this today is what does it mean to you and me? And so with the marginal rates, what seems to make sense to me is being aware of it. I wrote an article years ago. I don't even know if I shared it with anybody. Like if you're a homemaker and you're thinking about going to work, it makes sense to know what your family's marginal rates are because you're going to have income taxes, you're going to have FICA tax, you're going to have the tax of wear and tear on your body getting up and driving to work, you're going to have the tax of buying more cars. And then depending on how far your commute is, you're going to have that time as well. And so why the marginal tax rate gets into it. One of the articles I wrote years ago, I think the break even for the average family was that person needs to probably make about $40,000 to make any sense at all to go back to work. It may be a little less today because of telecommuting, but even so, there's a certain wear and tear.
I'm just picturing the husband and wife sit down before they make the decision and they have the 1040 out.
They do not do this on your own. Call your tax advisor. Yeah. I worse than that. I hate to think of the ones that are cranking it out. Like they're coming home tired. They get in arguments, and they're maybe making $300 or $400 a month for all that effort.
It could save your life.
It could say, you have less wrinkles.
And, sorry, IRS people, I didn't give you enough credit for that.
Yeah.
Save some grief for someone.
Man, those were the first people that came to my mind. Why you would want to know your marginal rate because it can really add stress to the family if somebody's working and it doesn't really add any value to their situation. I think that knowing this can help younger people manage decisions as well as older, and maybe some of us in the middle. And like the younger people with your contributions, I think when you know your marginal rate and you're looking at it, if you're in that 10 or 12% marginal rate, there's no reason at all. I think you should do a traditional, dude.
Yeah, makes sense.
Yeah. And then even if you're if you're up in the 22% rate, you may want to stop and think, why am I doing traditional rather than Roth? If you look at the historical marginal tax rates, they're probably going to be a little higher than what they are right now. Yeah. The two incomes, again, we talked about that. Self-employed, if you're self-employed, you have to look at all that stuff and kind of figure out how that all works on you because you're not only picking up your FICA, but you're getting two sides of FICA. So you're paying closer to 16% in FICA as well as your marginal rate. And you may have to ask yourself, is all this stress of doing this myself worth it versus maybe going and being an employee? That's a quality of life decision, right. But I've seen a lot of independent contractors that just look like they've been beat down and they're not bringing much home at the end of the day, that they might just let somebody else carry the burden for them. And so knowing your marginal rate will help you in that thought process. What other ideas come to your mind, Doug, in regards to that?
Well, I think we've covered most of the notes I had. I think the questions to ask are just what's the impact? Does this have a huge impact? Does my rate have a huge impact? What would I do differently? And there are a few tools that could help you bring your overall effective rate, back down. But and if you're in a small business, if you're employed or self-employed person, there's a few tools that are out there for you. But yeah, there's really not a whole lot you can do, I don't think.
Well, I think you need to be aware because like as you're approaching distribution management time as in your late 60s or 70s, there's the options then. Do I pay it now because you're going to be, when you hit your required minimum distribution age, you're going to be forced to take certain incomes, and then your choice is, do I take it sooner or later? Sooner might mean converting it to a Roth IRA where you can grow it tax-free versus taxable. And then there's the structuring of your income. If you're going to be in a high income year versus maybe the next year you're in a lower income year, and if you are doing itemized deductions, you can pull some of those deductions into that high income year versus the future year. So if you've got moving parts in your world, that's probably when you want to reach out to us and let us know. I put Mr. Stonks on top of the Rubik's Cube because it's not, just like Doug was saying, it's not real easy to navigate what you're doing there, but there are some decisions that make a difference. But if you're going to pull income forward, or you're going to do Roth conversions or things like that because of what you're thinking about the taxes, it's not quite as easy as just looking at the marginal tax rates. You're going to want to pull in your tax professional, because you can pull in, if you're getting Social Security now and you take more income now, it may affect the tax rate on your Social Security. And then it also might affect the income related monthly adjustment amount for Medicare, affectionately known as IRMA, which some of you are pretty familiar with. And that can be a pretty substantial kick. So all those moving parts like that, your tax professional can plug that into their software and offer you some insight.
I think some of the best advice we've heard from others around here is just, maybe it's not all in one chunk. Maybe you don't have to do something all right now. You could use a couple of tax years to get it done. Just like you've saved, it's taken years to get it, or maybe you have diversified investments. Maybe you diversify your ways of taking advantage of tax resources, but you just don't have to do it all in one chunk.
Yeah, and probably I would say I would reach out to us and your tax advisor if you're having an unusual income year. For example, if something extraordinary is happening, there's probably some decisions you can make in that particular tax year to help you in future tax years. And I was a little disturbed this week. I saw a TurboTax advertisement. I don't know if you saw that on TV or not, but they basically were telling you to fire your local tax advisor and hire them to be your tax advisor. That here's what, we love you guys so much, we're going to match whatever your tax advisor is charging you.
Okay.
Yeah. And I would highly discourage that. I think a local tax advisor is some of the best wisdom you can buy. And to relegate that to somebody that maybe overseas, I don't know how that's even going to help you one iota. But I would continue to buy wisdom. If you don't have a local tax advisor and you're concerned, I would reach out and see if you can't get somebody that can help you with it.
The local tax advisor has all the tools that a TurboTax system has. So you have a great system, but you also get the questions and you get the purpose behind what you're doing.
Yeah, and they, even though they probably will charge you more than TurboTax, I'd say probably in general 25 to 50% of their cost is accessing their software, and so you could access the software and do it all yourself, or you could access their brain and trust them to help you. And if they will make mistakes,
especially when something needs clarified.
Yeah, well, they will make mistakes, and you will make mistakes. But if they make mistakes, they're going to help you get it clarified a lot quicker. Well, I hope this has been helpful in explaining the marginal tax rates to you and why it may or may not matter. But if you're in a very low one today, I would probably look at some Roth conversions, and I wouldn't leave that money on the table. All right, you guys have a great week, and thanks for hanging out with us today.